great topic that comes up from Pavol. And Pavol, I agree with you, as you know. This does relate to Alice's question about hedging. Pavel's comment is, I prefer to hedge each stock position. That way I can decide later if I want to see if the market goes up without trying to time when to cash my market hedge like VIX. And I understand that. And that's, that's what I do too, meaning that we'd already mentioned about the limited risk radioactive trading techniques using that far term married put position, or you might even be using standard collar positions. So I already have the hedge in place on that position, meaning that I have a controlled risk up front, still, of course, with the ability to do various adjustments, sell calls against this in the shorter term. I almost did today. I should have. This is my AIG married put that's shown in the Fusion portfolio at Radioactive Trading. The stock, of course, moved up today, as many did. It went back to the range I wanted it to be. And when it was at 62.20 today, it had come up from about 60.10, I think, to 62.20. I was going to sell the 65 call for standard March expiration. It was 92 cents, somewhere in that range. And it was pretty good. But I was still feeling that it had more room to go, and it did. And it's not a lot, I know, from 62.20, 62.30 up to 63.16. But instead of getting 90 cents or 89 cents at the time, not too much. I would have gotten maybe 105, 106 for it. So that's something I would have done. But this is a portion of my portfolio. Actually, I don't know if I like that position as much as I should. I don't know if I got 1/4 of the risk in there, 106.50, 105 against the initial risk of 435. That's pretty good. Still a 2.9% if it moves up to 65. But we'll wait till Monday, of course, to see what happens. But this is a portion of my portfolio. It's more capital intensive, of course, in that case. And there are portions of my portfolio that where I'm still trading. This isn't my actual account, of course. This is just the webinar account. But these are, sorry, wrong button. These were the bull puts that I traded recently. Remember, we reviewed those 3 bull puts last week that hit expiration, that were open on February 7th for the 18th expiration. 2 out of the 3 expired worthless, and 1 was converted to a bear put debit spread. That was IBM, and the pendulum adjustment, and worked out successfully. I had to do the same thing with BA on Tuesday, the 22nd. This originally was a bull put, sold the 205 and bought the 202.50 for a return of around 13 or 14%. I had to use the pendulum adjustment on Tuesday when the market did that massive pullback. And of course, the pendulum adjustment for the credit spread position was originally, as I mentioned, we had the 202.50 strike with a 205 sold as a bull put. But when the market fell down to 203.90, what I had to do is sell to close this and bought to open this one. And then in one move, it turned it into a bear put debit spread, which remained in the money today. Thankfully, I was getting a little nervous as it started to move back up to 205 strike. But again, it's ended in the money as well. So all 4 were successful of the bull put credit spreads I've opened in the past 2 weeks. However, 50% of them had to be adjusted to bearish positions, IBM and BA, but they both worked out as well. Why am I bringing all of this up? This isn't a recommendation of the allocation you should use. This is what's just I'm using in my account that I'm comfortable with to meet my personal goals. So 50% or so of my portfolio is in those capital intensive married puts following the radioactive trading techniques and the idea and the blueprint. And we might even consider standard collar positions. 12 to 15%, right now there's none because we just crossed expiration, but 12 to 15% is in usually these bull put credit spread or perhaps bearish spreads, maybe bear calls, maybe bear put debits. And 10 to 15, it's usually only about 10 to 12, I'm usually doing calendar call spreads on stocks I can't afford to do as a married put position or as a standard collar. I had a discussion today with a customer on Amazon. I can't do a married put on Amazon. I don't have the capital to do it, but I might trade it as a calendar call spread. And then, I might have 4 or 5% or so looking at, it's actually less than that. I'd say 3 to 5%. Yeah, about 4%. 3 to 5%, maybe playing some out of the money strangles or straddles around earnings, lottery tickets just for fun, just in case there's a big pop one direction or the other. There's some cash sitting aside. And there's this. See, if there's a 10% correction, like we saw back in January, 8 or 9% as we saw back in September, this portion of my portfolio, as Pavol mentioned, and we just saw with the AIG position, those positions are all hedged, where even if the stock market falls 10, 12%, I can't lose more than 5 or 6% on any one position. And because they're far out in time, even in a 10% decrease, I'm not at that full loss on the trade. The put still has a lot of time value remaining, so I might only be down 3 or 4%. And most of my standard collar positions, very similar positions with protection, looks like a spread. But these are only risking probably 3 to 4% per piece. That's a terrible 3, but you know what I mean. If the market falls 8% like it did in September, it was only 7.5%, but 7.5%, 8% as it did in September, or that 10% we saw in January, this portion of my portfolio, let's say the total of 30% of my portfolio, could be down 50%. The stock, I started 6 or 7% out of the money. The stock falls 10%. My short put and my bull put is now in the money, and I'm probably looking at a 50% loss on those 3 or 4 positions I had open. The calendar spreads and a 10% decrease, the long leap option or long far out option I have in that diagonal spread with a 10% decrease, it could be down 30 to 40%. This is what I'm hedging. This is what I was talking about with the market hedge of perhaps VIX calls, buying puts on SPY, let's just say VIX calls, buying puts on SPY, maybe shares of a volatility ETF such as UVXY, just buying shares directly. What's the advantage of that using VXX or UVXY? And it's because it doesn't have an expiration date like the VIX calls. It's still going to increase in price. If there's a sudden decline, black swan event, the volatility ETFs are going to increase. Not as much as VIX itself. They usually lag a little bit, but that's okay. They can still be hedged, but it is just shares of UVXY or VXX. Or buying calls on SH or one of the inverse ETFs. SH is the inverse of SPY, so it might be do that. Of course, you can use SPX as well. They're just a little bit more expensive naturally, so that's why I use SPY. And what I'm trying to do is set up a number of positions, if I'm using SPY puts or this, setting up a size where this value might help me hedge maybe 40 to 50% of what I expect to lose on this leveraged portion of my portfolio. Now, when I do a bull put credit spread or you do a diagonal call spread, you can say to me, well, Mike, that's a low risk trade. You pay just so little money into the bull put credit or into the bear call credit spread or the bear put debit spread, you know your risk. Known risk is not necessarily low risk. Okay, this is where number one, allocation is key, which is why only 10 to 15% of my portfolio is in the bull put credit spreads. Why only 10, 12% are in the diagonal calendar spreads. Known risk does not mean low risk. You can get yourself into trouble very quickly if you do not practice proper position sizing. So known risk does not equal low risk. I'm hedging that portion of my portfolio with those type of outside instances, Pavol, so that I don't get caught in the lie of leverage and in an uncertain movement, that portion of my portfolio that's in bull put credit spreads is suddenly down 50%. And that portion of my calendar spread, a portion of my portfolio that's diagonal calendar spreads is not down 50%. I'm trying to use those SPY puts to hedge that leverage portion, which is a known risk, but that doesn't always mean low risk, and I don't want to take more than a 50% loss on one position to begin with. But in a black swan event that exceeds the downturn I was expecting, if I haven't already closed my positions, then I want to have that protection in place for that portion of my portfolio. Usually, okay, question comes in, well, how much to use? On average, it's about 2 to 3% of my total portfolio will be put into protection at times. I didn't protect, by the way, those 4 bull put credit spreads we mentioned, the 3 from last week and the 1 on BA that we're looking at for this week. because I converted those two to Bear put debit spreads, and I was comfortable with that as well. It's never a bad time to put on a hedge. The VIX still might be too expensive right now to buy calls or even do spreads on the VIX with it at 27.59. You might want to look, and they're going to be expensive too, but buying puts on SPY or QQQ, depending on that leverage portion of your portfolio, which index is it more geared to? Is it more geared towards NASDAQ? Is it more geared towards S&P 500? That would help you with that decision. And again, you see them here. These have been going pretty good. Let's just take a look at VXX. So, this had been working well. Shares, I'm sorry, I should have gone to EVXY. But in those time frames of that January decline, and then we came down, but then we started to see some other movements. These were opportunities here, VXX and UVXY, to hedge the portfolio. And we've got that movement on Tuesday right there, right? Starting to move back up again, some of those spikes that happened. But here's where things get a little bit tricky. And we'll have a product for you soon on evaluating stock or portfolio insurance. What you typically see with VIX calls as a hedge, even SPY puts, but VIX calls, using shares of UVXY or VXX in this case is what we're looking at. They have similar profit and loss chart. Or even using shares of an inverse ETF as a market hedge. And we'll take a look at another chart in a minute, but even puts on SPY or QQQ. Remember, this is VXX. This is the volatility moving up when the market's going down. What do we see here about this chart movement of this underlying security over the last 3 months? When you're using those types of securities as a hedge, once you see a pop, you usually want to close half of it, because a day or two later, it's right back to where it was. See a pop, you want to at least close half of it. As it starts to go down, close the rest. Going up, big minor pop here, may have sold half. Hey, it still worked out. Sell another half. I have a quarter of what I had left. It starts to come down. Get out of it. Management is key in this. It's not just hold on to your security, hold on to the market hedge, the puts on SPY, calls on the VIX, shares of UVXY. I'll get to that in a moment. But you see here, this is a good period of time, right? This was January. That was a good period of time. But again, 2 to 3 days later, you're right back to where you sort of started from. Okay, so you've got to be careful with the management of these. And just in the last 5 days, moving up good, working as a hedge, there's the pop, sell half. And as it starts to pull back down, quickly sell the other half here, or another quarter, or half of the half. So you still have a quarter left, because you're almost right back to where you started. If I got it here at a hedge and saw it rise in that fashion, had to do it. It's tricky. It's not as clear cut as you'd think. Timing is important, is what I'm trying to say. Using those kind of securities as a market hedge is important. Let's take a look at SPY. The same 3-month time period. Of course, we all know what that's kind of looked like, but so different. This is reverse because this is SPY directly. We were looking at an inverse. We were looking at VXX, which moves up when the markets come down. So I have puts in SPY, let's say in this time frame, bought them back here. January is going down, down, down. That's where the puts were at the maximum profit. Here's where my puts are at a maximum loss, but my bull put credit spreads, calendar call spreads were looking pretty good. Here's the low. And then it's right back to where it was, or getting closer, to this time period where they're losing now. Once, there's no way to call the bottom, but this first big move, probably even here, might have sold half. I'm sorry, yeah. There, probably would have sold half. Here, the other half. Then it started to move back up. I'd close back the quarter that I have left, if possible. Because I don't want it to run back up here, because that's going to be a loss on my hedge. Yeah, the market's doing better. And then you see it. You guys have been trading. You know this. You've been whipsawed on the stocks as well as SPY. And interestingly enough, we're panicking here on the, worried about certain things happening. We're buying puts here on SPY, maybe 30 days out, maybe 45 days out. And we have our big movement downwards. sell half, sell the other half, and if we catch it in this morning, I'm sorry, yesterday morning, my apologies, yesterday morning, maybe close the other part, because right here now, we're probably only looking at a hedge or a profit on the puts of maybe 8 or 10%. SPY is not down 8 or 10% from when we got in. I'm saying the puts themselves, once it moved back up, are probably only at a profit of 8 or 10%. How much now is that helping hedge your position? If it goes up again, we might start losing on the hedge. But thankfully, the market's going in the direction that we want for our other portions of the position. So that can be a little bit tricky, but again, I just want to point out that if you think it's time to do a hedge, if you think you're concerned that it is time to put on a hedge, what I usually tell our customers is that if you're asking yourself, is it time to roll my call? It probably is. If you're asking yourself, is it time to put on a hedge? It probably is. For nothing else more than it's going to give you a little bit more peace of mind, and you're going to be a little bit less stressed about it. 2%, 3%, maybe 4% or 5% of the total portfolio in a form of hedge, just to say, let me put this into some security that's going to gain if the market falls at this point. And those hedge securities, that leverage portion of my portfolio, and it doesn't even have to be bull puts. If you have a leverage portion of your portfolio that's in bought calls, for example, you'd like to have a hedge like that in place. The debit spreads, bull call debits, the calendar spreads, as I mentioned, maybe even iron condors, because you're trying to play the middle and thinking the market wasn't going to move that much. You might have a different sentiment now, but in any case, just like it would for bull put credit spreads, if the market does something I didn't anticipate, I'm going to be losing on the bull put side of my iron condors, just like I'd be losing on my bull puts that I had open or my bull call debits. It's a good thing to have in place. Or the market suddenly ramps up, and now your bear call side of your iron condors are being threatened. Good to have a different hedge in place in that case. That's a little tougher because the hedges we're talking about would have been declining as well in that case. But that's usually just our thoughts there on what we consider. I like to have a hedge in place. I like Pavol's idea of securing the stocks directly. That's what I like to do with the married puts and collars. But I still like to use those other strategies, but I like to have and want to have some kind of hedge in place in case the unexpected happens. And again, I'm not saying that I've moved directly into bearish spreads right now instead of doing bullish, because the market just seems too choppy for me. Jim brings in a question. I'm just going to reference back to what we talked about at the beginning of the presentation a little bit. He says, well, if buying the puts on SPY are expensive and buying puts or buying calls on the VIX are expensive right now, I don't think it was here for that earlier portion. He says it would be better to do a spread position to cut the cost. And we sort of talked about that. You could use a bear put debit spread on a stock position to help hedge it. Okay, we could use a bear put debit spread on a position, or on SPY, I'm sorry, or QQQ to hedge a downturn. But what we talked about earlier, and I'm sorry there, what was available on, we talked about the previous webinar that was there was bear put debit as a hedge. And earlier in the presentation, we had talked about, I guess if I spell everything right, I should have said, there it is. Bear put debit as a market hedge. In this example for Octavio, it worked out really well because the market had only moved down, I think, 5 or 6%. But again, the debit spread as a hedge on a stock or on SPY to hedge a portion of your portfolio, or QQQ to hedge a portion of your portfolio, is capped. So if the downturn continues and it goes beyond your expectation of 5 or 7%, if it goes to 10, 12, or 15, you are missing out on a further hedge. Yes, you can adjust it at that point, but that's why we were talking about earlier that sometimes it's better to have maybe just the long put in case the downturn exceeds your expectations. And that's just one way to look at it. But in this example, we compared that bear put debit on SPX, I think it was, no, it was SPY, I think, against just buying puts on SPY, buying calls on the VIX, buying shares of UVXY, and buying shares of an inverse ETF, such as SH or one of the ultras, ultra shorts, for example. And yeah, Octavio's worked best because of the amount of the decline. If the decline had been more than what we saw over the time period that we analyzed, then the others would have worked better. But it can be done. But you just have to make sure that you look at it and see how much you're actually hedging and what happens if the decline is more than you expected. The decline is more than 5, 6, or 7%. Is the debit spread still helping hedge that larger portion of your portfolio that you wanted to control or wanted not to risk?